My metals targets are, and I raised those as well back in early June, 200 for silver and 7,000 for gold. I think we had that huge run up in January, December, January into that top. And we've spent the last several months consolidating that in several steps. I think the lows we saw last week or whenever it was, I guess it was last week, those should be your lows for this period. And we come out of that for that whole consolidation. We come out of that and I think come out of it in a very steep way this summer and into the fall. Is well respected in the industry. He's well respected within the Federal Reserve. He's a calming voice. He's not somebody that, creates conflict. He's got strong views on long term where the Fed should go and what they should be doing that's different than what's going on now. I think Powell respects the position of chairman enough that he'll be a voting member. I don't think he's going to get into big conflicts with Warsh or try to run the committee from a second spot. I really don't think that's going to be the issue. But obviously there's going to be a little bit of drama until he leaves, I think. And worse right now, obviously there's talk about a rate hike and concerns about the economy being stronger than people thought and inflation being higher than people thought or expected. My take is that we are going to see inflation roll back over. A lot of what we've had here is basically, the result of the conflict in Iran, the run up in oil prices and other prices, commodity-wise, and that now that we're going the other way on oil and going the other way in terms of the conflict, at least seemingly, that you're going to see inflation get back to the downtrend that it was in before the conflict started. So I think not this meeting, but I think in coming months, Warsh is going to be able to cut rates. Warsh is going to be able to, operate a policy that he believes in. He strongly said, I believe, we're too caught in the month-to-month data, looking backward at backward-looking data and making our decisions that way. He wants to be longer term in this and understanding that AI and technology are going to have dampening effects on inflation longer term, and that just because the economy is growing isn't a reason to tighten. You really want to, he does want to shrink the balance sheet. He wants to get that back to a normalized balance sheet. As I've said many times, that's not going to be easy to do given the macro situation we have, because I think the economy is slowing. I probably said this when we met long ago, but I still think we're heading for a global bust, and which means it's not just a recession, it's something much worse. So ultimately, I think macro is going to trump any intention to shrink the balance sheet. He might be able to do small amounts of it at times, but between now and that bust, and I think a bust is next year, that once that bust hits, is going to be expanding the balance sheet is going to be the story, not shrinking it. So what little he gets done between now and then, if any, I think is going to be incidental. The market's they're talking about rate hikes. They're pricing in certainly no cuts this year. And I think you're probably between now and the end of the year going to see, at least one or two. Don't have to. But I am also a bull on the bond market and have said forever, the bond market sets rates, not the Fed. So I'm not too worried about how many cuts we have or whether they're going to cut or not, because basically I see it as the bond market is bottoming here, rates are topping, and that as the economy becomes more apparent, the economy is slowing, and as oil prices head for $60, and inflation looks like it's rolling over, you're going to see a big bond rally and rates are going to come down. The Fed will be following rates down, not leading them. I'm in the opposite camp. I do think that those things are happening and are somewhat offsets to what else is happening. But I do believe the economy without AI, meaning particularly the consumer economy, is rolling over, is slowing. We had strong retail sales today, and you can look at that and say, hey, what are you talking about? But under the surface, we incomes, although jobs are okay, incomes are not going to be able to prop up spending like that for very long. Savings has been drawn down. We've talked about forever a have and have not economy. That continues to be the case, that, half the economy is really struggling just to get by month to month, while the other half is kind of propping things up. I think as we move along, it's going to become heavier and less likely to keep this thing going. It's hard to see that right now because the manufacturing side, particularly the AI side, building these data centers and the energy that needs to expand to meet that, all that's kind of offsetting what would normally be a consumer-driven economy, starting to show signs of real fatigue. But I still think that's ultimately going to happen. And, as I say, because of the leverage in the system, which is far bigger leverage than we had in 2008-9, more leverage than we've ever had going into a downturn, is going to be the reason I say this is going to be so much bigger than just a normal recession. I call 2008 on steroids. And again, it's hard to see it right now. So, I can be wrong. But my whole thesis is basically you've got a combination of debt. I mean, I can't state it enough. Debt is so far beyond what it was in 2008. We were highly leveraged in 2008, which is what got us 2008-9. We're so far beyond that now. And obviously, just looking at the Fed balance sheet, for example, it was $875 billion going into October 2008. It got up to $9 trillion in the pandemic and is back down to six or seven. But we're so far beyond. You look at global debt obviously is so much beyond. Our government debt keeps growing day by day. We're crossing trillions like it used to be millions. So leverage, again, around the world is so much higher. And a lot of it is sovereign, and I'm not expecting this cycle the sovereign to go under because of the printing press. But still, there's an awful lot of debt other than sovereign. And when I talk about leverage, I'm also talking about derivatives. As I say, debt is the leverage on the economy and the financial system. Derivatives are the leverage on the markets. And we obviously know there's so much more in derivative exposure out there than ever before. And that enhances on the way up. But boy, does that take things down fast on the way down. And so, we saw how fast we went from everything being okay to not okay in 2020. We saw, October of 2008 to March of 2009, how fast things unwound. I think this one's going to be at least that fast and probably steeper. And people go, well, the Fed won't let that happen, or the central banks won't let that happen. I go, it's actually because of 2008 and 2020 that they're reluctant to go back there again. Powell stated it many times that we're not going to repeat the mistakes of the past. We're not going to do QE infinity ever again. And I'm sure Warsh has similar feelings. He wants to shrink the balance sheet. So what that means is they're going to be slow to react. They're going to be reluctant to react until things really get to a crisis. And by then it's so late that they have to come in with both feet. So it's not that they won't ease early, but it's getting to a right-sized policy. If you're going to have something very outsized, you have to do more than ever before. And their mindset is to do much less than ever before. So it's a bad combination. So what that looks like from an economic standpoint, I would guess we'll see double-digit unemployment. We've got a situation in this country where, there's a shortage of labor in some ways and skilled labor for sure. So I don't think it's one of those things where you're going to see it shoot up to 20% like 2020, that kind of thing. But we could get to double digits, and that'll be very painful. The economy, I don't think it's GDP so much that I don't have a number, whether it's going to be, down. I don't think it'll be double digit down, although we could have a quarter like that. It's more the financial system that I think is going to be under the gun. We've got pension funds loaded with private equity and private debt. Private credit, because they thought, well, that doesn't.
Do they do instead of a bailout, do they do a bail-in?
I think what you'll see in terms of the banks, I think you'll see the FDIC will be funded whatever it needs to be funded to cover their insurance liability. Beyond that 250 liability, I doubt in this country you'll see bail-ins. I'm guessing that all that money that's being printed, all that money created by the Treasury, they'll be using it in every creative way they can to keep consumers alive, keep everybody afloat. So in this country, I don't think we'll see bail-ins. Certainly there's a precedent for it in Europe, so you could see it over there. Silver, I'd say, because it's so economic and much more volatile, you could see that 70 or 80 is not impossible.
So that would be
Again,
from 200 down to 50 to 75 range.
Yeah, and what I tell people is I'm more comfortable talking percentages because, as you I'm sure well know, there are people out there like Michael Oliver talking about a $300 to $500 silver price this summer or this year. And I can't get there with my work, but I don't think he's crazy. I mean, I think he's got reasons for it, and we're in a very historic period, so I wouldn't rule it out. So rather than pick a number, my 200 is my best guess of where we're going, but that doesn't mean it can't shoot right through that. So but more importantly, percentage wise, I think wherever we go, you're going to see those kind of numbers on the downside. If the Fed reacted sooner, if the central banks reacted sooner to economic softness, and if inflation was down enough that they felt they could react more, they might be able to head it off. We might only have a lesser recession, and they might be able to head off the leveraged unwind that happens very quickly if they misstep. So it's really that. I think that if you see the Fed not misstepping and reacting pretty quickly, then you might be able to head it off. And again, you'd have to see it overseas too, because I think the real more vulnerable